Hey, all right. Hey, everybody. I'm just messing with my hair here. Get this semi-orderly. All right, let's wrap this class up. So a couple things. We are going to today cover what I cover in my last week of class. So my last week of class is taxes on Monday, wills, and kind of some planning, estate plan. I almost said family, like estate planning on Wednesday, and then Friday is exam prep. So this is like all the week 13 stuff. We're just going to knock it out today. Though I'll probably do the exam prep on another video. Okay, so let's jump right into this. Share my screen. All right, so here you've got my little catchy title here, and this is true. Tax law is for lawyers to teach, so I'm claiming it. And I've heard weird things come from accountants about this, not specifically about our accounting department. I would mostly trust them. But I've heard accountants say some weird things. And so, yeah, I'm a corporate attorney, so I'm going to teach this. All right. As far as this, it kind of depending on when you are watching this video, you can do the course evaluation right now. If you're watching it as soon as I publish it, you're probably going to have to wait a couple weeks. But this is important for me. This is my last year of review by other faculty, and they look at the student evaluation. So I think it's important that you get this in. And yeah, if you do, I'll give you 5 extra credit points at the end of the semester. I don't get to read what you say until long after grades are submitted, but I can see who did it. So as you get these things in, I'll add 5 extra credit points at the end of the, towards the end of the semester. All right. As far as other there are other announcements. I'm just not going to worry about them right now because I don't want to announce these things too early, but I will send out written announcements to you with deadlines. For example, the extra credit brief, when to get in all of the appeals, how that will all work. And then once that's all done, I'll get you your grade. Okay. So now we can jump into partnership income tax. And you know a little bit about this. Like we talked a little bit about this in Unit 5, mostly in talking about, just understanding what pass-through taxation means. After today's lecture, you'll have a better idea about how to do some tax planning, for example. So that's what we'll focus on today. All right. Again, this is important. Each partner's share of profits and losses is set out in the partnership agreement or an operating agreement if it's an LLC. Remember, the LLCs use partnership tax. So to see this, I'm going to minimize my picture a little bit here. And I'm going to share with you another whiteboard. So yeah, let's pull this up. Okay. And in this whiteboard, I'm just going to show you some kind of simple partnership tax issues. All right. So let's create an LLC, because remember, LLCs are taxed like partnerships. So you and I can have a law firm. All right. So we'll call this Targi Law. That's a good name for a law firm. It's actually a horrible name. But here we are, Targi Law. We're a professional business, so we'll be a PLLC, but it's just an LLC. All right, and the law firm made $150,000 this year, so that's great. That was the income, but we had expenses of $50,000, and so the profit of this, again, accountants, I expect you to figure this out as quickly as I did. It's $100,000. profit, and that is what you pay taxes on. You don't pay taxes on your income. And so I'll show you how to track this later, but you're going to pay federal income tax on the profits for the year. In this case, it's $100,000. All right, so again, it's you and me. Let's keep this simple. Here you are. Here I am. Okay. And of course, this math can be quite difficult, but do this in my head. $50,000 for you and $50,000 for me. Now, we could have said in our operating agreement that I'm a 80% partner and you're a 20% partner, and then we would apportion the profits according to our ownership share. But most law firms and most businesses, they split equally amongst the partners. So that's what I'm going to do with you. We're 50-50 partners, meaning you will be apportioned $50,000 of the profits, and I will be apportioned $50,000 of the profits, and I will pay my taxes on that. All right, now, let's say this is your only job. Well, you're only going to pay taxes on the $50,000. Your tax bracket is probably going to be, I don't know, like an 18-ish% tax. And so, well, let's just say 20% tax. So you're going to pay $10,000 in taxes, meaning, so it's 50 minus 10. So really, you're going to be walking away with $40,000. All right. Me, on the other hand, I'm a lawyer, but I'm also a professor. So let's say that I've got $100,000 that I make a year from being a professor at BYU, Idaho. Well, lucky me, that I'm a W-2 employee at BYU, Idaho. So they're pulling taxes out from every single paycheck that I get from campus. So yeah, I make 100 grand, but I'm probably walking away with $70,000 to $80,000 after taxes. All right, but then I've got this other issue. I've got another $50,000, and that hasn't been taxed yet. So what that means is at the end of the year, when I go to file my taxes, it will always say, like, enter your W-2 income if you're using TurboTax or something, and you just kind of input all your W-2s, and then it'll say, do you have additional income? I would click yes, and I do click yes, and I enter Targi Law, and then it asks me for the information off of that K-1, and we'll explain that all in a second too. But that's where I put in, I made $50,000 from the law firm, and it says, cool, you owe another $20,000 or something, and then I will enter, and then I will pay that when I file my taxes, assuming that I didn't prepay taxes through the year, which is an option. Okay, so that's kind of where we are there. Let me stop sharing that. And yeah, let's head back to our slides here, because here you've got your file, the importance of filing your tax returns. So again, the partnership isn't taxed. Remember, like, the partnership itself is never taxed. The partnership files a K-1, which was it's just an informational return, or sorry, an informational filing that goes to the IRS that says, hey, IRS, Targi Law made $100,000 profit this year. There are two partners, they're 50-50 partners. Here are their social security numbers. And the partnership, yes, will file that K-1. But that just kind of alerts the IRS that, hey, when we process the returns for you and for me, because it has our social security numbers on there, let's make sure that they included this partnership income when they filled out their own personal tax return, the 1040 that we all fill out when we're filling out taxes. Well, I say at the end of the year. Of course, it's due in April most years, unless there's coronavirus going on. It'll be due in April of the year following the taxable year. So if it was 2019, we presumably do that by April of this year. Okay, so that's that. Now you know what a K-1 is, and yeah, it's a 1065 is another word for it. It's just an informational return. Okay, so jumping down to the third bullet point on this slide, The partnership provides a K-1 to the IRS and to each partner. And then each partner reports that info from the K-1 on his or her own 1040. Now, what's important here to understand is that the business may lose money. And I'll show you this in a minute. I'm going to pull up my accounting forms for my law firm this year, and I've pulled out a lot of the income, so it's showing a big loss. And if there is a loss, well, if we go back to our whiteboard, like instead of having a $50,000 profit per partner, what if there's like a negative $10,000 loss? Well, you can take those losses and it would offset income derived from my W-2 employment, my BYU Idaho, meaning I'm just going to get a bigger tax return because my business lost money during a given year. So, and again, you'll apportion the losses just as you would profits, 50-50, or just use the operating agreement to figure out how you're going to apportion profits and losses. Okay. Now here's where we get into estimating and paying your taxes. So this is important because I've had some students, they've been classified as independent contractors, so they're not W-2 employees. They just get a check every month for whatever it is that they're doing. And some of my students, like I had one last semester, he made like $50,000 as an independent contractor. He thought that they were pulling out taxes. They weren't. So when he filled out his taxes just a month ago, that's when he realized he's going to owe like $10,000 in taxes. And he came to me in a panic because he's like, Brother Hales, I've spent all that money. I don't have $10,000 to pay my taxes. So we sat down and kind of came up with a plan for him. But that can be a horrifying thing to realize that you owe taxes, especially if you don't have the cash. So one thing that I recommend to all businesses is that they prepay their taxes through the year, and you're able to do this on a quarterly basis. And yeah, you'll pay it in April, July, October, and January for the quarter just preceding that. And this is a great way to like not be stressed come April about coming up with 10 grand because you've been prepaying it through the year. Now, if you don't prepay it and you owe more than, I think it's $1,000, then you get penalties. So they're going to pay you or charge you. The IRS is going to charge you interest for not prepaying your taxes during the year. But here's how I've gotten around that. So let me share with you a different screen on Chrome. All right, so what we've got here is QuickBooks. Now you don't have to use QuickBooks. There's Xero. There's a lot of other accounting software that's available online, or I guess you could use an accountant. Why do that? All right, so I use this because it's an easy way for me to track my income and expenses, mileage, and a couple other things. I'm just going to show you around here. So this is the home page. You can see just a quick screenshot of what's going on for me this year. So my income for the year of 2020 is negative 7,800 pretty much. Why? Well, I've made $5,000 income, but I have $12,500 of expenses. And my expenses, it just kind of divides them up in this screen right here. And of course, this screen has my different accounts, my credit card, as well as my checking account. I don't have any invoices right now, but this is where those show up: mileage and estimated tax. So let's just kind of go through these. Let's go through transactions first. So when you come into transactions, I've got a couple of these that I need to categorize. So over the weekend, I bought Star Wars, what is it? The Rise of Skywalker or something. And I use my business credit card because it's associated with iTunes. So is that a business expense? I'm going to put that as a personal expense. I also went to Brolam's, was getting some stuff for some students that some friends of mine, they're students here, but they were from our ward in Florida and they kind of ran out of money. So I'm going to turn on my light by waving, and then I'm going to classify that as personal too. Apple, I don't know what that is. YouTube, I don't know what that is. An online payment. This is when I paid my credit card bill. from my business credit card. So that's just a credit card thing, and it's not going to affect anything in here, but yeah, that's just going to classify it as a credit card payment. So, all right. But if we scroll down here, you can see kind of the things that I have received. So back in March, I received an online payment. Oh, that's just a credit card payment too. Let's see the last time somebody paid me money. All right, so February 18th, a client paid me $250. So that's income. And then usually if I click on that, you can see the name of the client. I just kind of keep track of stuff like that. Clothes, if you buy clothes, like I bought a bunch of white shirts, that's, even though I wear it for work, you have to classify it as a personal expense. But right above it here, you see this Freddy's, $15. That's, I took a friend and we went to Freddy's, and that's a meal, and meals count as business deductions. Now they're only counted at 50%. Why? Because you have to eat anyway. That's kind of the general rule there. But a lot of these, and a lot of the business income that I took out above here, I just took that out, but that increases your tax liability. But most of these, like transaction and processing fees, that's going to reduce, these are business expenses, and they're going to reduce my taxable income by that amount. So again, Sam's Club, I went and bought paper and other materials for my law firm. So that, again, these are deductions. Meals, legal and professional services, contract labor, transaction processing fees. And yeah, what's great about it is, oh, here's an unclassified one from March 13th. I think that was personal too. But actually, I'm going to change this real quick. I'm going to say that it was a business expense, and I can come here. So it classified it as materials and supplies. But what's great is I can come through here, I can show all categories, and I can see, and I can label every dollar that I spend. Like, let's say it was furniture. I bought furniture for my law firm. I click that, and it becomes a furniture expense, and it will input it at the end of the year in the appropriate place when I'm filling out my tax return. So let me just fix this real quick to personal so I don't cheat the IRS. But that's the beauty of this. It syncs up with my business checking account and my business credit card, and it allows me to classify everything that comes in and keep track of my income and expenses. And at the end of the year, when I use TurboTax to file my taxes, it just grabs everything from QuickBooks, imports it into TurboTax, and it's a simple tax return issue. So, all right. So yeah, I think that's a good overview of the transaction section. And of course, it will keep track of your business income and your business expenses. So, all right. Now, miles are also tax deductible. So when I drive my car for business purposes, I'm able to keep track of that using QuickBooks. And what I'm doing right now is manually inputting my miles every month. But QuickBooks has an app wherein you can just say, track my miles automatically. And every time you drive, it'll say, hey, you drove 2 miles today. Was that business or personal? If you swipe to the left, it makes it a business mile. If you swipe to the left, it's personal. If it's personal, it doesn't count. But if you're driving for business, you get, what is it now? 5.75 cents as a deduction for every mile that you drive for business miles. So I often drive to my client's house. I used to have an office downtown Rexburg. That was a waste of money, so I got rid of it. And now I drive around a lot, and I'm able to deduct, use as an expense, my mileage at that rate. So that's good. Here in my taxes tab, this tells me, let's see, financial profit. I'm guessing this is last year. It's saying I made 33 grand. And my deductions were 25 grand. And just kind of breaks it up by category here. And if I click on the quarterly, I can see that, let's see. So it's saying in 2000, so it's saying I'm going to have to pay taxes, even though I'm at a loss right now. It knows that I'm at a loss because I pulled out a lot of my income because I didn't want you to see that. So um, it's guessing that I'm doing something weird, and so it's saying that for my fourth quarter of 2020, I'm going to have to pay taxes of basically $2,400. And so yeah, that's that. And if I had a big profit right now, it would tell me how much I'm going to have to pay taxes for by April 15th. That's what that tab is all about. And then invoices, I won't click on that one, but that allows me to create invoices directly from QuickBooks. It emails the client with the invoice and they can pay online. And I just pay a fee for that service, but it makes it kind of nice because I don't have to wait for a paper check, do things through the mail. It's just through email and they can pay me online. So that works out well. But that's QuickBooks in a nutshell. And like I said, it's not the only accounting software. There's plenty of these. And it's been beneficial for me to be able to track all of my expenses. Now, if I go back to, let me stop sharing that and go back to our slides. Let me see here. I'm gonna jump ahead another slide real quick, just because we're kind of on this topic. Like, what is it that counts as a deduction? Some of you are wondering this. Like, well, it's any expenses incurred for the purpose of the business. So you saw all the categories on there on QuickBooks. That's great. That tracks everything that you need. Now, but in general, this slide has a lot of the most common ones, like any of your startup costs. When you pay the Secretary of State $100 to register your LLC, that's a business expense. That's one of your startup costs. So count it. That's reducing your overall tax liability, because yeah, you made $500 this year, but you also paid $100 to register your company. So you shouldn't be taxed on $500. You should be taxed on $400. Operating expenses like rent, internet, cell phone, accounting fees, any expense used to keep your business in business. Advertising costs, obviously I'm looking at maybe doing some Google ads down the road. That is a business deduction. Business related meals, again, I take friends, I take clients out. We talk about the law firm, we talk about their business. If I pay for that with my credit card, that's a business expense. Travel is a big one. So I don't have any employees right now for my law firm, but I kind of do. So and what I mean is I don't have any full-time employees, but I do have an employee. It's my daughter. She's 13. She helps me with filing. She tracks some of my deadlines. And right now I don't pay her. I could. And there's some serious tax benefits of hiring your children as employees. A lot of that is tax-free. And I'm probably going to do that when she starts doing a little bit more work. Like right now she helps, but she's 13. Like it's not like she's a super productive employee or anything. But even though I'm not paying her, I do, she is working for me, and we go on retreats. So it got canceled this year, but next month in April of 2020, I was going to take her to London. We were going to go meet with one of my friends who's a big shot attorney in London, do some networking, let her kind of see what legal work is like in the UK. Now we were also going to sightsee. Like I wasn't just taking my daughter to talk to lawyers, right? Like we were going to go do other things. But taking her to London, that's a business expense. That is a business retreat. And I'm going to classify that as business travel. And travel is also a business deduction. Okay. And then this last one is important. If you don't know, just Google it. Like when I first got all of these white shirts and ties and suits and all this crap to be a lawyer, I thought, this is great. This is all probably a business deduction. I Googled it and found out, no, it isn't. You don't get to deduct clothes. And you don't get to, like, there's a lot of things that you think you would get to deduct and you just can't. Haircuts. No, sorry. You can't deduct it. All right. So that's the idea with business deductions. Now, this gets me on kind of a rant. Okay. So I'm a corporate attorney. I represent businesses. Right now, my businesses are kind of split East Coast and a couple in Idaho. And invariably in December, I will get a call from my clients and they always say, Michael, it's the end of the year. I want to reduce my tax liability to zero. Like, help me spend money. And let me explain to you the absurdity of this, right? And I think to do this, let me pull up that whiteboard again. So if we pull up the whiteboard and let's make me little again. All right, so we pull up the whiteboard and here the law firm has $100,000 in taxable profit. All right, well, these LLCs will say, I just don't want to pay taxes. Help me get rid of this. Right? So there's lots of things you could do. This $50,000 of business expenses, we could increase that. We could bump that up to $150,000. And one thing I like to joke about with my clients is I say, well, a great tax deduction is legal fees. So let me bill you $100,000 in legal fees, and then you won't have to pay any taxes. Well, to that, they normally say like, well, I don't think I need $100,000 worth of legal fees. To which I respond, exactly. That's my point. So, and some of you are starting to get what I'm getting at. But here's the deal. Right now, this partner is going to pay 10 grand in tax. This one's probably going to pay $10,000 to $15,000 in tax. So let's just average that. Let's say that it's about $20,000 in tax. All right. But in return for that, between these two parties, they get $80,000 of cash in their pocket between the two of them, $80,000. So I always ask my clients when they come to me with these stupid questions, I say, would you rather have $80,000 in you and your partner's pockets, or would you rather spend your money on crap that you don't need? And that's when the gears start turning. They're like, oh, okay. So I say, look, if you've got capital expenditures that you need, but like, let's say you've got your server, your computer, your work computers, they're old Microsoft 95 or yeah, like some old computer from when I was a kid, right? And it's just not working anymore. Do you need a new computer? Yes, go ahead and buy it. But if you have computers that are working fine, why are you going to spend money just to save a little bit in taxes? Right? And this always bothers me when I get these calls, like, help me spend money so that I don't have to pay taxes. Well, there's a trade-off here. And that's what I'm saying. Like, right. Yeah, you may save money on taxes, but you're going to lose your income, your profit, the money in your pocket is going to be gone. And so that's what anyway. So if you ever hear anybody say something like, oh, I got to do something to avoid taxes, I need to buy something, I need more business deductions, help them see how stupid they're sounding. Okay, 80 grand in your pocket or a computer that you didn't need. I think that's an easy decision. Take the money in your pocket and pay the dang taxes. Okay. All right. That's my rant. I'm gonna be done with that one for a little bit. All right. So let's stop that and get back to this. Okay. So we've talked about that. Now here's another one, self-employment taxes. Okay, self-employment taxes are additional taxes beyond federal income tax. And what this is that if you are taxed as a partnership, you're an LLC, a partnership, or an S Corp. Well, hold on to the S Corp stuff. Then you will pay self-employment taxes. And this is set at 15.3% of income up, and it's capped at the first 128,400 that you make. And that may be last year's number. So I'm gonna double check that later. But like, just what you need to know is it's like your first $128,000, $130,000, you're gonna pay a self-employment tax. Now it's capped at that amount to incentivize you to just keep making more money than $128,000. Beyond that, you don't have to pay self-employment tax. Now, this goes to fund Social Security and Medicare. If you're a W-2 employment and you see FICA withholdings or Social Security withholdings, it's the same thing. But again, if you're self-employed, you have your own partnership, you're gonna pay taxes on that. We're just not gonna. You don't have a line item in your paycheck, so we're going to call that self-employment taxes. Again, 15.3%. Now, there was a trick, and accountants used to say this, and I think some still do, and I disagree with this, but they would say if you file as a S Corp, so you file it, you're a corporation, but you check that box saying I want to be taxed under subchapter S of the Internal Revenue Code, then you can get out of self-employment tax. And that's not true. This is a misconception. You can get a potential reduction on self-employment taxes. But to help you see this, I'm going to have to use the whiteboard again. So let me come back to this. I'm going to share the whiteboard. Okay, so let's just clear this off. And okay, good. So here's how the S Corp used to work. All right, so let's. So what you could do is, as an S Corp, let's say that you made $100,000 in a given year. Well, you could designate some of this money as one, so we'll call this dividends. Sorry, I'm bad at drawing with this thing. And the rest of it you could call salary. All right, and what would happen is you pay, let's say you do $50,000 in salary and $50,000 in dividends. Well, you could save a little bit on this self-employment tax because you only pay the self-employment tax on the salary and not on the dividends. So you could save potentially 15.3% of $50,000 by being an S Corp instead of an LLC or a partnership. Now, this has largely been taken away. Why? Because LLCs can now elect to be taxed as an S Corp. So you could have an LLC and do this same, and kind of knock this off, and do the same trick and save a little bit on self-employment taxes. But it's not that easy. And there's a couple issues here. One, S corporations tend to be audited more than LLCs. They look for this. They look for people that are making their salary artificially low and increasing their dividends in order to take advantage of this, what some would call a loophole. And some people tried this. They'd say, my salary is $10,000 and my dividends are $90,000. Well, the IRS doesn't, I mean, the IRS isn't stupid. So they require that every S Corp have a reasonable market value salary. And so really this, what's considered reasonable, it's somewhat subjective. But kind of the rule of thumb that I've seen a lot is that if the S corp isn't making per shareholder like at least $300,000, then it's all going to have to be classified as salary. Under this scenario where we've got $100,000 in the S corp coming to one of the shareholders, all of it is going to have to be salary. All right, there's no 50-50 here. It's just going to be 0 for dividends and 100,000. But if you get over $350,000, then you might be able to say a reasonable salary is, $250,000, and the rest goes to dividends, and you may save a little bit there. Again, cool, but again, you can do this as an LLC. And remember, LLCs do not have the formalities that corporations do. So in LLC, you're much less likely to ever have the corporate veil pierced for not following those formalities, whereas with an S corp, because it is a corporation, you have to look out for that, and you do have to follow the formalities. Otherwise, you lose that wall or veil of liability protection. So again, I used to hear a lot of accountants say, don't do an LLC, do an S corp, and here's why: it's self-employment tax. My response to that is, no, it opens you up to additional potential liability, additional potential risk of audit, and the gains here are minimal. Like, unless you're making a ton of money, you're going to have to classify all of that as salary anyway. So, all right, so there's my second rant about why accountants are wrong about pushing S corps. LLCs are simply better. Okay, done with that rant. All right, let's get back to our slides here. Okay, so now we get into the tax reform of 2017. So this was Donald Trump's kind of signature tax reform when he first came into office, and went into effect for the tax year 2018, and obviously 2019 as well. And this chart shows a lot of those changes that you read about. So again, if you kind of look at this chart, you've got taxable income up to 19,000. You're going to be taxed at 10,000, or sorry, at 10%. So yeah, and these are marginal rates. Let me kind of explain something to you, because here's where, all right, I guess this is going to be my third rant. Okay. Let's look at this chart. So let's say that I've got a client, because this always happens. I've got a client that is going to make is going to make in a taxable year $410,000. All right. So that person is going to be in this 35% marginal rate tax bracket. Well, there's this stupid misconception out there that if you're in this tax bracket of 400,000 to 600,000, that you have to pay 35% of all income in taxes. Now, some of you accountants have studied this and you're like, that's dumb. Yeah, thank you. That's what I'm getting at. So a lot of these people are like, good gracious, Michael, help me not be in the 35% tax bracket. I'd rather be in the 32% tax bracket. Don't let me go up to 35. At which point, again, I just want to slap these people. All right. I would like to be in the 35% tax bracket. That means that you're making above $400,000. I wouldn't mind that. I would carry that cross with happiness. Right? But the misconception kind of originates from this idea that you pay, that marginal rate is your tax rate for everything, and that's just not true. You have to. This is a step up tax rate, meaning your first $20,000 is taxed at 10%. The next, what is this, $55,000 is taxed at 12%. So what this marginal rate means is it means that is the amount of tax that you spend on your last dollar of income. All right. So if I make $410,000, my tax rate, my full-on tax rate is not going to be 35%. It's going to be somewhere like 25 or 23%, so somewhere in there. That's going to be my real tax rate. I'm just going to have to spend, so remember I said $410,000. So that means for that last $10,000, I'm going to pay 35 right here, 35% on that last $10,000. That's within that bracket. But I paid 24% on all of my dollars between all of my income between $165,000 and $315,000. Does that make sense? I hope this is making sense. I usually get this on the board and kind of drive it home while we're in class. I hope you're getting it now. This is vitally important. And if you ever hear anybody complain that, oh my gosh, I'm in the 37% tax bracket, woe is me, slap them and remind them they are one of the lucky ones. They're making so much money that their last dollar is taxed at 37%, but not all their income is taxed at 37%. Now, as part of the Tax Reform Act of 2017, all of these rates came down. So this first marginal rate used to be 12%. This 12% used to be 15%. The 22 used to be 24, and so on. So and this one used to be 39.5. And this is important because right now we've got the Democrat primaries going on, and kind of our finalists right now as of mid-March. We've got Bernie Sanders and Joe Biden. Joe Biden wants to take these marginal rates and push them back up to where they were under President Obama. So take the 10 and make it 12. Take the 12 and make it 15, and so on. Just kind of bump these up 2 or 3 percentage points for each tax bracket. Bernie Sanders wants to blow these up, like make them way higher. Okay, and same with the corporate rate, and we'll get to that in a second too. Now, in return, Bernie Sanders says, in return, like it's not like I'm just increasing everybody's tax rates and hoarding all of that money. In return, he's pushing Medicare for all and a bunch of other government-supplied benefits to the population that he says will make it worth the increased taxes that all of us will spend. And I think he's got a point. Like in some areas, I should say, we spend a whole lot of money on healthcare in the United States, and so the idea is, let the government take that over. We as the government can negotiate much lower rates than 3,000 different healthcare providers can, and we'll set the rates for the doctors, and then everybody's going to save money. Now, I've got some real problems with that, but in general, like in theory, what he's saying, it makes sense. And for a lot of people that can't afford healthcare, this makes a whole lot of sense. And so that's kind of the intersection of politics and tax policy and tax law as we're seeing it right now in 2020. Okay, so here's some of the other things to keep in mind. Like the Tax Reform Act of 2017, it didn't only just reduce those marginal tax rates, it did a number of other things. So you've got the standard deduction here. The standard deduction, what this means is, I should get my whiteboard out again, but yeah, I'm going to. All right, so the standard deduction says, right here, let's clear this out. All right, so let's just look at Laura and me. So my wife and I, right now, let's say together between her job and my job, we make 100 grand. Well, we've got a whole lot of deductions, right? And from it, when you're filling out your 1040 using TurboTax or Tax Act or whatever software you use, it will start compiling all of your deductions. Now, some of the main ones are these. So it used to be, it's called charitable contributions. That says charitable. All right, so, oh, I have a text thing up here. Oh, that's beautiful. Okay, so I'm going to take this out and move this down. Let's do that. Let's draw. Okay, so $100,000, and then we've got all of these deductions, right? Like, let's say that we spent, it was a bad year for the Hales family. We spent $20,000 on healthcare. Okay. All right, and then let's say we spent, because we are LDS, we spent $10,000. Let's make sure these are thousands. And then we spent $10,000 on this thing us Mormons call tithing, fast offerings, donations to DI, right? So maybe that's $11,000 after the end of the day. Okay, well, these are all common deductions and interest on our house. So all of these things get added up. And what that does is at the end of the day, let's just say like 10,000 miscellaneous. At the end of the day, that's 40. That means that Laura and I are only going to pay taxes on $60,000. Even though we made $100,000 together, we're only going to pay taxes on this. That's our real taxable income. Okay, so if I clear all of this, this is interesting because what the Tax Reform Act did was it said, look, we've got people itemizing their taxes, meaning doing what I just did on the screens, you know, going through healthcare, insurance payment or interest payments, all of that, and they're itemizing to get their full deduction and then their taxable income. The standard deduction used to be $12,000, but Trump said, let's just double that to $24,000. So now, when you've got a couple making $100,000, the standard deduction is 24, which means that you would only pay taxes on $76,000. Now, you'll use this standard deduction unless your itemized deduction comes out higher than that, which in my hypothetical example, it did. So even now, again, like most people just use the standard deduction because it used to be 12, now it's 24. That's a lot of money. And most people, when they itemize everything, like the interest payments, the health care, child care costs, all of these things that are deductions for personal income, most of the time it doesn't come up to $24,000. So you can just take the standard deduction and say, woohoo. Now, on the other hand, if you're paying $10,000 in tithing, $20,000 in healthcare, you're already above the standard deduction. So in that case, you're going to itemize rather than use the standard deduction. Okay. All right. So there we have that. Okay. So the second bullet point here in the slide, this one's important, and it's one we already talked about at the beginning of the semester with the Affordable Care Act or Obamacare. And it's the reason that Obamacare is back, heading up to the Supreme Court, and the Supreme Court's going to determine whether or not it's constitutional. Because remember, the Supreme Court found that it was a tax because there were penalties if you didn't have health insurance. Well, President Trump came in and as part of the tax reform of 2017, he told the IRS, we're not going to enforce this anymore. If young people, like my college students, like you, now granted BYUI makes you have insurance, but let's assume that they didn't. Most of you wouldn't get health insurance. Why? You don't get sick that often. It's the 80-plus-year-olds that are always sick, and they use like 80% of healthcare services are for really old people. Don't quote me on that exact number. I don't think that's exactly right, but most of our healthcare is used by older people, and you, college students, who tend not to get that sick, you're not at the hospital as often, on average. So you tend to not get health insurance. Well, if you're not getting health insurance and paying into the system, then that whole financial burden falls to older people to pay for all of their health insurance. Now that seems fair to us, but to them, they're like, hey, you know, we bought health insurance when we were young and old people were using it then. We feel like our healthcare should be subsidized by younger people. And so if you look at it through their eyes, you're like, okay, you know, still no, I'd rather not, but that's the logic behind it. And again, President Trump said, I'm going to require young people to get health insurance. And that is going to subsidize the older people and their healthcare needs. Well, President Trump Trump came along and he tried to repeal Obamacare, but he didn't have the votes for it. So he just said, cool, I'm going to tell the IRS not to enforce that penalty. So young people have stopped getting health insurance again, which is starting to bite them right now that we've got coronavirus going on. But that's the decision that they made. And so, so yeah, the healthcare mandate was ended. You don't have technically it's on the books that you should have healthcare, but if you don't, there's no more penalty associated with it. Yeah, so it's kind of like it's not required anymore. Okay, now this third bullet point, this was a slap in the face to Californians and New Yorkers, liberal states, Washington, Connecticut, a couple others. See, you used to be able to get a mortgage interest deduction for all of the mortgage interest that you pay during a year. And if you get a $1.5 million home with a 30-year mortgage at whatever interest rate, those early years, every dollar that you spend towards that mortgage, pretty much, not everyone, but a very high percentage of your mortgage is interest. And you could take all of that interest and deduct it from your, but like going back to my whiteboard, Laura and I's $100,000, but we spent $30,000 in mortgage interest this year. That's really going to reduce our tax liability for the year. President Trump said, well, and I'm paraphrasing here, but he said, you know what, I'm going to cap that at $750,000. Meaning, if you buy a $1.5 million house, that's great, but you're only going to be able to permit a mortgage interest deduction as if that loan had been $750,000. So we're going to reduce, sure, you paid $30,000 in interest that first year, but the IRS is going to say you can only claim $15,000, for example. Like, I'm just kind of making up these numbers, but you see what's going on here. This hit disproportionately Democratic voting states like California and New York. People that used to have a very high deduction, reducing their tax liability, Trump got rid of that. Well, didn't get rid of it, but he reduced it. And so that was a slap in the face to liberal states. And it didn't end there. He also, with the state tax deduction, Democrat states like California and New York tend to have high taxes. And so President Trump, that like it used to be, you could deduct from your personal income taxes the amount that you spent on state taxes. And President Trump said, that's ridiculous. Like, the federal government needs money too. So I'm going to cap that state tax deduction at $10,000. And you can see why California and New York didn't like that. In fact, they sued him over these two things, saying you're targeting liberal states that didn't vote for you. That's unconstitutional. And I think those have been dismissed, but I haven't really followed up on those very much. All right. Finally, we get to the corporate tax rate. Now, the US corporate tax rate used to be set at $35,000. It's now under Trump's plan. Trump said, I want to drop it to 20%. Democrats came back and said, no, we need it to be much higher, 35%. And then they ended up settling on 21%. So Trump kind of won this one. A couple things are interesting about this. I think this is probably a good place to draw it on the board again. Because now we'll say we've got instead of having an LLC partnership tax, let's do the corporate tax. So we've got Targhee law. the professional association. So this is a corporation, all right? And you and me are the owners of this. Again, 2 owners, 50-50 partners. Well, let's say Targi Law, again, makes $150,000 income. We're going to allow those deductions here on the corporate level. And so the corporation will be taxed at a 21% rate off the bat. So remember, this is the key difference between corporate tax and partnership tax is the corporation is going to have to pay a tax. So here the corporation is going to pay let's get this right, $21,000 in tax, meaning that we're going to be left here with $79,000 that can be distributed to the shareholders. Now, here's the interesting thing about corporate tax that I didn't really hit on last time, but you need to understand this. The corporation doesn't have to distribute anything. It doesn't, these right here, to you and to me, these are what we call dividends. And a corporation doesn't have to, there we go. The corporation doesn't have to pay dividends. It could just say, cool, we're good with the 21% taxes and this $79,000, instead of distributing it, we're going to keep it up here at the law firm. And that's basically investment in ourselves, and it isn't going to be taxed anymore, right? You keep we call that retained earnings, and you're only going to be taxed once. Now the problem is most law firms aren't, they're not going to be able to keep all the money in the law firm. They've got to give it to the owners of the law firm eventually. So in this case, let's say that they just distribute 20 here and 20 here. Well, great. But these individual shareholders, you and I in this case, are going to have to pay taxes at our own personal rate for the $20,000. And the other, what is that, $19,000 is just going to stay in the law firm, and that's going to be our capital investment. Now you don't, and this is key, you don't have that option with an LLC. With an LLC, you've got $79,000 and it's a pass-through entity, meaning it's going to go straight through. Well, shoot, forget what I just said. You've got this $100,000 and it's going to be taxed at the individual rate here. So this is the corporate, the corporate issue right here, the corporate scenario, I should say. And that doesn't even look like it says corporate, but it does. I'm just making it worse. And so let's say that each of those individuals is at a certain tax bracket. Let's say it's at like, I don't know, let's say 20% and 20% of $20,000. I knew this, it's $4,000. So this person's going to pay $4,000 in taxes, and this person's going to pay $4,000 in taxes. So together that's $8,000. So what I'm doing is I'm adding this up, right? That's $8,000 plus the $21,000 that was already spent at the corporate level tax. So that brings a grand total of $29,000 taxed under the corporate tax regime. Now, if we erase a lot of this, right? Like I'm gonna erase. Well, shoot, I'm erasing too much, but you'll see what I'm doing here in a second. If we erase all of this and go back to partnership tax, well, we've got 50 here and 50 here, and usually both of these they're going to be taxed at about the 20-ish% tax rate. And so you've got $20,000 taxed under partnership versus, again, on average, like if we're assuming a corporate tax rate, you're probably going to spend about, or pay the business in total about 29. So this is under corporate tax, and it's 29 under partnership, and it's 20 under partnership tax. So you can see this is why most people elect to be taxed as a partnership rather than a corporation. You save from the double taxation issue. Okay. Okay. So that's good there. Now you can kind of see why it is that most people elect to be taxed as partnerships rather than corporations. All right. So we're back here to the corporate tax rate. Now, one thing that the tax reform of 2017 did is that it allows full expenses of short-lived capital investments. What this means is you used to buy a $10,000 computer and you would expense that over the life of the computer. So if it had a life of 5 years, then you would only be able to expense $2,000 a year for that nice computer that you bought. Well, Trump said, that's dumb, like just expense it the year that you buy the computer. So now you buy that computer and you get instant $10,000 tax relief in year one, tax deduction, I should say, in year one that you bought that $10,000 computer. That's kind of another benefit of the Tax Reform Act. Okay, here you've got an overview of pass-through income, but I think we've really already done that, except I do need to say this. Another critique of the Tax Reform Act of 2017 is that in it, so in that last slide, we were talking about the reduction of the corporate tax rate, right? From 35, what was that? 35 down to 21%. Well, LLCs and partnerships said, hey, what about us? Like, you're reducing the corporate tax rate so much. Can you reduce the pass-through tax rate as well? Well, that's a little bit more tricky, right? Because it's not a corporate tax percent. The LLC is never taxed. It's passed through to the owners. But what President Trump did is he created the second one right here. The law created a 20% deduction for pass-through income. So again, yeah, it's just a deduct. Like you and I have that LLC law firm, and the law says we're just going to like in our case it was $50,000 for each of us. This law says, okay, only tax them as if they were paid $40,000. So you get kind of $10,000 tax-free in that scenario. But here's the catch. President Trump said, in essence, lawyers don't vote for me. So this whole pass-through taxation thing and tax reduction for pass-through entities, it's not going to apply to law firms. Now, that's not totally accurate because if the taxable income, if the pass-through income is less than $157,000, then you still get it. You still get this pass-through reduction, even if you are a law firm. So most associates and even a lot of partners don't make more than $150,000. So again, but it was kind of like Trump slap in the face at lawyers or something, because they tend to vote overwhelmingly for not Republicans. All right. The death tax, the estate tax is what this is really called. This just increased, yeah, I'm not going to spend too much time on this. This is so dumb. It applies to so few people in the country that I don't know that it even matters, but it's important for Republicans. So the idea here, by the way, the estate tax exists to keep the U.S. from creating a bunch of like Downton Abbeys. like we don't want, like we broke away from Britain for a reason, darn it. And so we didn't want dynasties being created in the U.S. So when you died with certain amount of assets, it could be taxed. And Trump increased the amount that you have to be taxed. So right now, you could leave, when you die, you could leave $11.4 million to heirs and pay no federal tax. Now, opponents of the estate tax, they say like, what the heck? Like that money was already taxed during that person's life. Why are we going to tax it again just because they died? I get that. I understand that. But again, the Democrat response is, like, what do we do? Like, why wouldn't we? That's $11.4 million getting passed on to somebody else. Let's tax it. Again, I mean, the joke is Democrats never saw a dollar they didn't want to tax. Here you go. So that's what this is all about. Again, I just don't know that it's worth the time. Okay, so all right, so now we've left taxes behind. Now we're going to talk about wills. And here's a couple things that I want you to know about wills. So now we get to talk about death, right? And this is something that was weird for me. I was in law school and I took this class called elder law. I had no idea what I was going to be doing. I figured it had to do with like estate planning, that kind of thing, but I didn't really know. And I went in and the whole time, like, it makes you think about dying. And that may sound like I don't want to do that, but I think it's important because the truth is we're going to die someday. And that's hard to hear when you're a college student. I get it. Yeah, like when I was a college student, I was running around like, stupid things, saying stupid things like, I'm going to live forever or whatever. Like, no, you're going to die. Right. And if you're going to die, the question becomes, how are you going to leave your assets? How are you going to leave your estate, pass that on to heirs? Well, if you have no will, then this slide right here tells you how you're going to leave your estate to your heirs. So again, if you die with children but no spouse, everything goes to the children. If you die with a spouse but no descendants, obviously your spouse gets everything. If you have parents but no spouse, then your parents get everything. Like these are just the default rules for Idaho. This is what happens when you die without a will. All right. Now some people think, and I've had students ask me this. They're like, well, they say things like, well, I thought that if you didn't have a will, that everything just goes to the state or something. Like, no, it goes to your family. Now, if you don't have any family anywhere, then or only like super distant relatives, well, then cool. You've just become a Jane Austen book. Like, it's going to go to the third cousin 3 times removed somewhere else, and they're poor living on the street, and all of a sudden they're rich. It's like, cool, you just made a book out of it. But assuming we can find some family somewhere, that's where it's going to go. And it's the same thing with children. I had one student like really stressed out. They're like, my parents don't have a will. Does that mean when they die, I have to go live in an orphanage? I'm like, what? No. I was like, as long as you have some family member living somewhere, the courts are going to decide where you go. But it's going to be a fight, and that's going to be ugly. And so we'll talk about kids here in a second. But before we talk about kids, we need to talk about community property. So Idaho is a community property state. What does this mean? This means that when you marry someone, you typically, like any assets, income derived during the course of marriage becomes community property. So like this picture says, all of a sudden, like what you make becomes you and your spouse's. Now, Laura and I have been married for 15 years. For almost all of that time, I was the only one working in the home. So every time I made money, it would go into the family checking account, and it was our money. It was hers, and it was mine, and it was ours. That's what it is. And that's what community property, that's like the major tenet of community property. Now, there are some exceptions to this. If one spouse inherits money during marriage and that money doesn't go to the joint bank account, it goes to that one spouse's account that they opened up just for that purpose, or just a separate account, I should say, just a separate account. Then that inheritance remains the separate property of that spouse. Now, if I tried to pull this off, Laura would kill me. Like, Laura just inherited $1 million from, like a Jane Austen novel. My third cousin, great uncle, twice removed or whatever. And I'm going to put it in this other account so that it's just mine and you don't get any of that. Well, again, Laura would murder me. Like she wouldn't be happy with me. So don't do that. But you can, with inheritance, you can keep it separate. And you may want to do that for a lot of reasons beyond, like the most obvious reason is maybe you're going to get divorced down the road and you don't want to split up that inheritance from your grandma or from your parent with your soon-to-be ex-spouse. That's one reason to keep it in a separate account. Okay, and then other separate properties like income and property that you brought into the marriage that you never put into the joint account. You kept it separate in your own account. That's always, and you never let your spouse have access to it. That's separate property that you get to keep separate as well, okay? So that's kind of a brief overview of community property, but when you die, that becomes important because the community property is distributed among your heirs. And yeah, that's kind of the main thing that I want to get across with community property for now. Now, guardianship. Now, lots of you in this class, you're young. If you are married, some of you are married. Some of you are married and you just had your first child. Some of you are married and have like 3 children, but most of you are like single, looking at getting married. And so you're thinking, why on earth do I care about a will, Brother Hales? Like, I don't need a will because my assets, like Laura and I think I told you, Laura and I, our assets constituted like 3 bags of ramen and $20 in a checking account. Like, we had nothing when we got married. We were so poor. My 3rd year of law school, we couldn't afford a bed, so we lived on one of those crappy inflatable camp mattresses or air mattresses that deflate through the night. Yeah, that's how poor we were. So like the thought of us needing a will just seemed absurd. And some of you are wondering that, like, why are we talking about wills when we're college students? Well, the main issue is this slide right here, this guardianship stuff. Because once you have a child, well, you may have a child and be like Laura and I. Jessica was born during my 1st year of law school. My very first day of law school is when she was born. And we still had nothing. In fact, we had less than nothing because by the time she was born, I had taken out, I don't know, $60,000, $70,000 in debt for that 1st year of law school. Like, we had nothing minus $70,000. Okay. So for us, it was like, well, like, who cares how our assets are distributed when we die? Because there's nothing there. Here's the key. You have a kid, and if you and your spouse die with and you have a child who doesn't die, well, the question becomes, where does that child go? Well, the courts are, if you don't decide that, the courts are going to decide. And that means your parents are going to go to court saying, we want custody of the child. And your spouse's parents are going to go to court saying, no, we want custody of that child. And maybe a sibling or somebody else, they're going to fight over who gets custody of the child. And this is devastating to families. This happened here in Rexburg about 4 years, I think it was 4 years ago. A couple was flying their plane. They took off from Rexburg Airport, a little prop plane, and crashed. And it was the husband and the wife. They had like 4 or 5 kids and no will. And mostly it was okay because they didn't have a whole lot of assets, but the issue became who gets the kids. And the parents of both the deceased parents, so the grandparents of the kids, they were all fighting over custody. And the stakes are high here. Imagine what, like, you being the grandparent, your son or daughter just died in a plane crash, and now your connection to that son or daughter, that's your grandchildren. And somebody else might get custody. And if they get custody, you don't know how often you're going to get to see your grandkid. And so this is it. Like, those of you that are newly married or going to get married and are going to have a child someday, write a will, if nothing else, for the sole purpose of having a guardianship, of saying where your kids are going to go in the event of you and your spouse's death. Now remember, this only applies if you and your spouse die. If I died right now, there's no question where the kids go. They stay with Laura, my wife. It's their kid. If she died, I get the kids. That's obvious. But if Laura and I are traveling together, as we often do, and get in an accident or something happens to both of us and we both die, then now we know, because we have a guardianship, where the kids are going to go. Now, how you choose who your guardian is, that's up to you. But be smart about it. we thought about this for a long time. First, for a while, it was my parents, but then they went on a mission and couldn't become the guardians. And so then we looked at our siblings. And when we did this, like, Laura's, my wife, has one brother. He went to MIT and now he's in San Francisco and he's making a ton of money. And we're like, that's the guardian. So if we died, our kids would go to San Francisco and grow up there with Uncle Johnny. Now they would be the beneficiaries of my life insurance policy. The trustee of our estate would sell our house, and that money would, all of that would go into a trust for the benefit of our kids. And that's all set up in our will. And if you go into iLearn, I've done this for you. So I've created a will for you. Now there's two of them. One is titled husband's will. The other is titled wife will. And that's because the husband and the wife both, like, you don't write a will for the two of you. Each individual has to write a will, and they're identical except in the way that they identify each other. Now that we're in this world of same-sex marriage, it's probably wrong of me to label them husband will and wife will, but even if it was a same-sex couple, they could still use those, just insert their names, and they're totally fine. But the way that we set it up is this. If I die, everything that I have goes to Laura. If Laura dies, everything that she has goes to me. That's it. If we both die, then the kids go to live with Uncle Johnny, you know that. And all of our assets are liquidated and go into a trust. A trust is just an artificial entity to hold the money. So a bank account would be created and it would be titled the Hales Family Trust. I think we got cute, called it like the Hales Angels Trust or something like that. I know, that's cute. You should be impressed with me. And my sister, so I've got a sister who lives in Arkansas, but she's the trustee over that trust. So she is in control of that money. And the money is paid to the children as they need it. So Johnny, my brother-in-law, would be their guardian. Johnny and his wife would be their guardians. And as my kids needed money for school expenses, he would make that request to the trustee, who again is my sister, living in Arkansas, and she would distribute the money out of the trust to Johnny as needed for my kids' education, missions, etc. And that's how it is. Now, if you designate somebody as the guardian of your kids, make sure that they know it. Okay, don't just like put it in your will and then never tell them, and it's a surprise. Like, hey, you get the kids. Like, we talked to Johnny beforehand and he said, yeah, I'd be happy to be the guardian. And I talked to my sister and she said, yeah, I'd be happy to be the trustee. And that's the way that we set it up. Now, you set it up so that there's a guardian and then you have a backup guardian. So like, what if Laura and I die, but Johnny's already dead or something, or can't do it or doesn't want to do it anymore? Well, then we've set up backup guardians and it just kind of goes to the backup person. That's how that works. But again, I'm giving you that will. If you go to a local law firm around here, they'll charge anywhere from $2,000 to $4,000 for something similar like that. I think that's ridiculous. So I'm giving it to you for free. Again, cost of tuition, definitely worth it in this case. So now this last point here on this slide, if you don't have to pay a lawyer to write a will. So if you use that form that I'm giving you in iLearn, you're going to have to get it notarized. You fill it out in front of so you fill in all the names of guardians, trustees, names of kids, all of that. But then you go to a notary and you sign it in front of a notary with 2 witnesses. And it's self-explanatory. It has, here's witness 1, here's witness 2, here's where the notary signs, here's where the notary goes. And again, this is one of those contracts that has to be notarized. Okay, so sorry, my lights are off. There we go. Okay, but if you don't want to do that, if you don't want to get it notarized, you can actually just handwrite all of this. Now, the key is it has to 100% be handwritten. So you could write a will, just get a blank piece of paper and write, if I die, all of my money goes to my wife. If my wife dies, all the money goes to my kids, or however you want to word that. But the most important thing is just write a guardianship. You can just write a guardianship, but it has to be 100% handwritten. So you can't type it up and then sign it. The whole thing under Idaho law, this is kind of weird, but it's important that I'm telling you this. The whole thing has to be handwritten. Or like I said, you can just use the form that I put in iLearn, but you have to make sure that it's notarized. Once you do that, make a copy, send it to your parents, send it to the future guardian, keep a copy at home at a place where people can find it, and voila, there you are. There's my mini lesson in estate planning. Okay, and again, those handwritten wills, we call those holographic wills. So that's what this slide is all about. This is the holographic will. These are the requirements. You have to be over 18. It has to be handwritten. Again, you have to sign it, and you don't need a witness. If you handwrite it, in other words, a holographic will, it just has to be 100% handwritten and signed. No witnesses are required. So, all right, that's it for that. I will make one more video for the final exam prep, and we'll go from there. All right, thanks everybody. I'll see you soon.